What does mortgage mean? By mortgage, it means a long-term and not short-term financing need to buy a property. And the property you are buying will also serve as a collateral for the loan. Who are the authorized financial institutions to give mortgage? The primary mortgage banks, which in very also happen to be one of the leading in the industry, are the licensed mortgage institution to give mortgage. Also, commercial banks are also giving mortgage to few selected customers. What are the things we need to know when taking the mortgage? I've mentioned property, which is the first step that must be identified. Either you have a property of your own that you want to buy, or you are buying into a development by developer. So the second is the documentation. That documentation, if an individual is buying the property or they are taking the mortgage, the process, some of them because of the cost that the lawyer will take, they might decide to overlook all that and be deceived by the kind of property or the way they see the development. But here, we do all the due diligence from valuation to charting to title verification. And in title verification, we ensure we do soft and hard search. Soft search means electronic search at land registry. Why hard search is that they go into the archive of land registry to see all the transactions that are taking place on a particular C of O from beginning to the end. Because it's not, sometimes there are instances where you won't have some of those things in the electronic some build without having proper building plan approval, and other government agencies approval required to have the kind of development. The next is the equity contribution. When you want to buy a property of 100 million, you don't expect a financial institution to finance 100% acquisition. That means you are taking all the 100% risk, you are passing 100% risk to a third party. You also believe in a property you want to buy, you should have a stake in that property that you want to buy. So that's the essence of the equity contribution. And minimum benchmark used to be 20 to 30% before the new subsidy from the federal government through Federal Mortgage Bank, Ministry of Finance Incorporated, and the Family Homes Fund. They are the one that lower the access to home ownership by reducing it to 10 to 20%, so that majority of Nigerians can use that to reduce the housing deficit, which is about over 20 billion. Those that are that are contributing to pension, that are in paid employment. So use 25% of their retirement savings for the purpose of home ownership. What are the main criteria for eligibility? Number one is consistent and verifiable regular income. Anyone that is in paid employment and has been confirmed, they are eligible. So it now depends on how much are you eligible. It depends on your income bracket. The first one, the loan mortgage must take it for minimum of 5 years, not 1 year, not 2 years. But that doesn't mean that if the customer wants to pay down below 5 years, that he can't do that. But the mortgage must be for minimum of 5 years. And for anyone to be eligible, you must have minimum of 5 years to retirement. In Nigeria, the maximum retirement age is 60 years. People in the bench. So they have 65 and 70 respectively as their retirement age. But have a clean credit history. Credit history means have you taken loan in the past and pay back without history of delinquency or history of default. So we, by regulations, are supposed to do minimum of 2 credit bureau search. Anyone that has never taken any loan from commercial from back before is not a plus. It's those that have taken several and paid back without history of default. That's a plus for that person. Next one is for those that are in diaspora, they are also eligible. We do foreign credit search for them to know what are the other obligations they have in their foreign land. Where do they work? Do they have a permanent residency there? Do they have in the global sanction list and other due diligence for those in diaspora? And husband and wife can also co-borrow for the purpose of the mortgage. One can be a primary applicant while the other will be a co-applicant. And the next is a repayment. The benchmark for mortgage repayment is 1/3 of income. Anyone that earn 1 million as a monthly income, for the purpose of mortgage, your monthly repayment must not exceed 1/3 of that, which is 333,333 naira. This is the global benchmark. And for the purpose of mortgage, the salary account of the borrower is where we place direct debit for the purpose of this monthly repayment. Direct debit deduction on that account. And if at any time the borrower is changing job, they need to notify the bank, or that will form as the basis of a default to call in on such a facility. Where we have a co-borrowing arrangement too, we will split the repayment based on the income of each of the borrowers. Maybe husband and wife, maybe 60/40. In some instances, we might have 50/50 repayment method for acquisition. The first benefit is the pre-mortgage due diligence, which I've mentioned earlier. Any benefit is steady rental income. Beyond if you take a mortgage and you're using that as an investment, the monthly rental income, incremental. And if you are living there, it's even a plus for you. It is the opportunity to also pay gradual reduction in the outstanding principal without default after 24 months. It also has a tax benefit. If you have two individuals, Mr. A mortgage for the purpose of his own acquisition. The other one, assuming your tax is 500,000 payee every month. Mr. A that use mortgage for the purpose of his own acquisition is paying 500,000 as mortgage. As a tax. Mr. B is also paying 500,000 because you use mortgage. Mortgage repayment has two components: the principal repayment and the interest repayment. All the interest you are paying on the mortgage is a relief on your tax. So Mr. A that use mortgage will be paying 300,000 as tax, while Mr. B that use 100% equity to purchase that to continue to pay 500,000. And the fifth is it tax against inflation. If you don't, some of these properties that are going for 100 million, 2-3 years ago, majority of them are for 45, 50 million. And what's the workflow for mortgage? Anyone that wants to take a mortgage, digital platform for your account opening. After the account opening, another digital link for you to apply for the mortgage and submit all the documents there. From there, all the due diligence and all the title to the property, you just upload it there. And the next is to make payment for the equity contribution and the due diligence cost. After that, once you submit all your document that is required for the bank to do the underwriting, if you are eligible, the next is to pass it through the approving authority. And once that is done, the next is to have your documentation, offer letter, loan agreement, and all the necessary documents that will enable us to conduct the survey plan, from survey plan to title perfection, and for the bank to place a legal mortgage on the property. And immediately the customer finish paying the loan, release the ownership of the documents to the buyer. And for the Gove that we are launching today, the conservative price for this development today is 220 million because customers are buying off plan. By January, we might not have it as 220. What are the options available for this acquisition? The first one is outright payment. Once you make 100% outright payment, we will release all the documents to you. The next is to wait for the completion date for you to have your key for. And what are the payment plans that we have that I've mentioned briefly? Upfront payment of 30%. Anyone that is buying now, 30%, which is 66 million. And in the next quarter, another 22%, which is 44 million. While the balance of 10% upon completion will be 22 million. Priced into three. The first one is to do with due diligence and the management fee payable on the mortgage. The second has to do with protection fees. The protection fees are the insurance on the property, like fire protection. If anything happens to that property, the insurance company will reinstate the borrower back to the state the property was before the fire. And in the case of mortgage protection, nobody prays for unexpected, which is death. If anybody that has a mortgage die, and we have this mortgage protection insurance, irrespective of the outstanding principal loan is, the bank the insurance company will pay. Even if it's just for 6 months, the customer has made that repayment. And in the case of permanent disability, the insurance company will also, and as a result of that incapacitation, the insurance company will continue to pay for the mortgage till the last day. Our mortgage advisory fee is just 1% of the loan amount. So if it's 100 million, it's 1 million. If it's 60 million, it's 600,000. If it's 40 million, it's 400,000. And then there's also regulatory stamp duty fee of 0.375, which is a one-off that goes to the federal inland revenue. And the rest is the title perfection to change ownership from the seller to the borrower. After that, the bank will now place a legal mortgage to show that though the property belongs to Mr. A, but the bank has a stake in that. That's what a legal mortgage means. And the property insurance I mentioned is 0.25% of the loan amount. And to make it easy for our customer, rather than taking is an annual cover, but we take a quarterly charge to make it easy. If we divide that into 4 and we charge customers quarterly, which has also factored into the monthly repayment. And for the credit line, which is that one is 0.052.